Good morning, everybody. Monday, October 21st, 2024. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. You can follow me intra-week on either LinkedIn, Herb Morgan, or on X, formerly known as Twitter, at Herb W. Morgan. The presentation you're about to see and hear has been created by me at Cantor Fitzgerald Investment Advisors. It is designed to be used by both financial advisors and individual investors, but each are expected to make their own investment decisions. Nothing contained in the presentation should be treated as investment advice. There's no tax advice, no recommendation for the purchase or sale of any securities. Everything is purely for informational purposes. Stocks continue to perform very well. The back-to-back years of 20+% gains are looking more and more likely as we move into late October now. The S&P 500 is up 24% year to date. We are getting not only participation, but now starting to see more outperformance of small and mid-cap stocks, as you can see happen last week. They're still well behind for the year. They're big cap brethren, but doing quite well. International markets declined last week, and no, that's not a typo. Both the EFI index and the EM index were both down exactly 37 basis points last week. Bonds were bid, done well, but we have been seeing a rise in yields ever so slightly ever since the Fed decided to cut rates. That's a steepening of the curve. That's a disinverting of the curve. It's also a normalization of the curve. But the overall rise in those intermediate rates, like the 10-year, which is at about 4.18 this morning, is a sign that investors remain concerned about the possibility of further inflation or of a spike in inflation as we move forward. Let's get into last week's economic data. We got the New York State or Empire State Manufacturing Survey. You can see over there on the right, the little drop fell from a 30-month high, which wasn't that high, but the 30-month high of 11.5 to a 5-month low, negative 11.9. There was an estimate that it would be positive at 3.6. However, I wouldn't read too much into this, likely driven by the bad weather and the labor strikes. Now, the labor strikes were primarily concentrated. Remember, had the port strikes in the south, in the southeast, and in the east, and the eastern seaboard. New orders fell from 9.4 to -10. Shipments fell to -2.7. Employment, though, went higher. And I think most importantly, as I went through the report, I saw that the gauges of prices paid and received both rose. These are the kind of little tidbits or nuggets of information that are going to determine where we come in on inflation, CPI, PPI, PCE, all of those numbers, and that may help or hinder, in this case, hinder the Fed's ability to continue to move toward a more neutral policy stance from the restrictive to now less restrictive by 50 basis point stance. 6-month outlook, however, climbed to a 3-year high of 38.7. So I would dismiss the labor strikes, dismiss the weather, focus on more of the positives, or, believe more of the positives in this particular survey. We then got the Philly Fed Outlook survey. This is not the official full Philly Fed survey, but the Outlook survey rose from 1.7 to 10.3, well above estimate. You can see it over here on the right-hand side of the graph. New orders spiked significantly from -1.5 to 14.2. Shipments rose from -14 to 7. Employment fell, surprisingly, but the outlook really had a big jump from 36.7. So what this tells me is we may have bottomed out in that manufacturing sort of quasi-recession, remembering that manufacturing is only about 15% of the U.S. economy, and we're seeing signs of things turning there, and I find that positive. That's good, right? Import and export prices report for this month of September showed that import prices were down 0.4%. Export prices down 0.7%. Largely, most of this, the import prices, especially due to oil price declines, and import prices without that still rose, but only 0.2%. This is relatively good news in the fight and the battle against inflation. As suspected, jobless claims came down from the prior week. We had that spike due to the hurricanes. We believed it would be quite transitory. It came down from 260 to 240. May come down even a little bit further this week. We'll have to wait and see. Continuing claims rose a little bit to 1.867. Again, had a lot to do with the hurricane situation down in the southeast part of the country. Retail sales were expected to come up 0.3 in September. They beat that. They came up 0.4. Backing out autos and gas, we were up 0.7. The gains were very broad-based. There's 13 categories in the retail sales report. 10 of them showed a pickup, and gasoline sales showed a decline, which is certainly positive news on that inflationary inflationary data. Industrial production and capacity utilization, which are signs of economic activity, also can be indicators of inflationary pressures in the economy. Industrial production dropped 0.3% in September after a 0.3% rise in August. Obviously, again, the strikes, the hurricanes likely subtracted about 0.6. You take that out, and probably a pretty good report on production and capacity utilization for the month of September. Business inventories, which have been on this nice, you can see, nice string of pickups here. Business inventories rose 0.3, right in line with expectation. Third consecutive month of exactly 0.3. Manufacturers' inventories, if you break it out by manufacturers, wholesalers, and retailers, manufacturers up 0.1, wholesalers up 0.1, retailers really picked up 0.6. In the prior month, they had picked up 0.8. That has a lot to do with bringing in inventories for an expected holiday shopping season, which will be upon us before we know it. Housing sentiment improved from absolutely horrible to just a little bit less horrible, from 41 to 43. It was above the estimate of 42. As a reminder, the number here that we're concerned with is 50. When it's below 50, the nation's home builders are not feeling particularly good about their business. When it's above 50, they are feeling particularly good about their business. Present sales rose a little bit to a still below 50 reading of 47. Future sales, they're getting more optimistic. I think they're seeing the path of rates, and as rates come down, that certainly benefits either home buyers, home builders, and all the ancillary industries around that. And traffic was up a little bit to a still very low reading of 29. Staying on the theme of residential investment, housing starts and permits, which fell 0.5% in September for housing starts. Permits fell about 3%. Nothing particularly great there. Really, it's still all waiting for rates to start to come down. But speaking of rates, Glenn Ombach, one of our portfolio managers here, actually the co-CIO with myself on the managed ETF portfolios, came up with a really great chart relating to mortgages that are outstanding in the U.S. economy. And one of the reasons home sales have been so low is many people are locked into very, very low mortgages. And it's only the new mortgages that were at the higher rates as the Fed increased interest rates. So the question was, if you look at the totality of the mortgage market, what percentage are at 8, 7, 6, 6.5%, where the current rate is for a 30-year fixed mortgage? And what we found was that the balances are still very, very much in this 2.5 to 3. You can see there it's 2.4 trillion. This 3.5 is $1.6 trillion. And you get down here, there's really almost nothing over 8, and very much the same, you can say, even over 7. Not a whole lot. If you add all of that together, it's less than, I think, $500 or $600 billion that are at these higher rates, which of course could be refinanced as rates come down. But it shows you why the housing industry, basically seized up as interest rates went higher, because it's buyers and therefore sellers and everybody else, everything around it is very much dependent upon interest rates. And for those folks that were locked into these low rates, who maybe were thinking about moving up, why would I trade up to buy a new, bigger house to go from a 2.5% mortgage to a 7% mortgage? So the industry just sort of seized up, starting to thaw, starting to de-ice a little bit as rates come down, but we've still got quite a ways to go there. The other thing that Glenn pointed out this week that I thought was pretty fascinating is that over the last decade, the typical 30-year mortgage rate has been 200 basis points above the 10-year Treasury, meaning if the 10-year Treasury is at 4.1, then the 30-year mortgage is at 6.1. But that's really not the case today. The gap is much wider. So either interest rates might come down a little bit on the mortgages, or yields could go a little higher in the 10-year, which they've been doing lately. And perhaps there'll be some mean reversion. There might be some optimism, reason to look forward there. But just a good little data pickup by Glenn Umbach this week. The other thing that's happening in the market is we've seen this rotation. I mentioned at the beginning of the commentary when I talked about, hey, small and mid-cap stocks have been performing better in the very near term. As you know, for us, we have been a little overweight in the large and the big cap tech and very richly rewarded, but not in the last 6 or 8 weeks. Okay, that's okay, no problem. But one of the reasons small and mid cap stocks are starting to pick up and we own both in the portfolios, may do better for the rest of the year is that it is starting to appear, based on polls and based on other data that we look at, that it is probably more likely than not today that Donald Trump, is likely to win the U.S. presidential race. And those odds have risen according to lots of different sources. And if that were to be the case, if Trump were to win, there's several presumptions that are now driving that outperformance of small and mid-cap stocks. Number one, that tax rates are likely to either remain very low at the corporate level, perhaps even go lower, as he's been talking about. There's talk about increased spending, widening fiscal deficits, perhaps, that will go along with that. But increased spending is the G in the GDP, not G in GDP, but the GDP formula at C plus I plus G, government spending. Number three, tariffs, which would be protectionist to U.S. industries. Small cap and mid cap companies have to obviously compete with foreign competition. Lower regulation, especially in financials, which tend to be concentrated in that small and mid cap space. Greater policy certainty, pro-business policy, regulation, et cetera, and higher consumer confidence that would all come from that. Those are the presumptions in the marketplace. And add on to that, when you look at the consensus estimate of earnings for, say, the Russell 2000 blended forward right now, we're looking at about 32% growth. That's likely to come down, but currently it's showing about 32% growth going into 2025. The trade has been going on for, as I mentioned, for several months. The market has broadened out instead of it just being the Mag 7 and the big cap tech. And the other thing is, of course, the large mega cap trade is just a little bit crowded. We've all been there for a long time. We've all benefited. Our portfolios have benefited. And there's just perceived a little bit more value in that small cap stocks. But wait a second. Did I just say all the odds are in the favor of a Donald Trump victory right now? And the answer is, yeah, it really is kind of looking that way. Eric Johnston here at Cantor Fitzgerald went back and looked at historical patterns in the swing states. And in order for the Democrat traditionally to win the swing state, they would have had to have been polling at least 1 to 2 points higher than the Republican candidate, as Republican candidates, and particularly Donald Trump in his last 2 elections, we actually have data, right? Because he's run 3 times now. Trump has traditionally underpolled and over-delivered in the swing states. We also know there are no additional debates scheduled, and Donald Trump didn't do particularly well in the last debate. Harris did, so that would favor Trump. Trump tends to do well with rallies and interviews, which he has many scheduled between now and Election Day. And Vice President Harris did much better in the debate. I think that's clear, but there's no more debates. And she has not done particularly well with interviews. She did had very struggled on a couple of recent interviews as well. Of course, anything can happen. I'm not making a total prediction right now, but I do look, every couple of days at the Real Clear Politics Electoral College Map. They poll in all the different states. They amalgamate the different polls, not just their poll, but every news outlet. They put them in, and then they try to say where are the polls leading. As you know, you need 270 electoral votes to win the presidency in the United States. And according to the latest polls, maybe a month ago, I may not have this exactly right, but it was just super close. And I think, it was like the Trump side was at like 250 or 260 or 268. And it's just been slowly climbing. You can see Pennsylvania, a swing state, Wisconsin and Michigan, Ohio, swing states, Georgia, swing state, Arizona, Nevada, very big swing states. They all seem to be, according to these polls and according to this map, moving towards Trump. All of that contributing to that rally in the small cap stocks. We are well into earnings season right now. We've had 72 out of 499 companies report. 54 of those beat, 6 in line, 12 behind. Average earnings surprise is about 6%. Negative in the industrials, but it's only, it's really been 9 companies. We'll give that some time. Negative in energy. That's not necessarily a bad thing for the economy. That can often have to do with energy prices coming down. It's early. This week, big week, lots of companies reporting. And economic data this week, not a ton. We had the leading economic index this morning. Estimate was be down 0.3%. I think it was down 0.5. Nothing big tomorrow, Tuesday. Existing home sales, the Fed's Beige Book comes out ahead of their November meeting. On Wednesday, jobless claims looking to be about the same, about 242. The October flash readings for S&P Global's manufacturing and services looking at 47.5 and 55. Don't be entirely surprised if it's above that 47.5. That's my little prediction of the week, I guess. New home sales at 700,000 annualized. Friday durable goods and Michigan consumer sentiment. We're available, as always, audio, any podcast format. Best place to see this, of course, is on the YouTube channel, Slaying Bulls and Bears, where I, your host, try to make the complex and complicated as simple and sensical as I can. Thanks, everybody. I'll be back to you again next week.